This book, part of the Wiley Finance series, is a comprehensive guide to understanding the principles and practices of risk management in modern financial institutions. It bridges theory and real-world applications, making it widely used in both academia and professional finance. Main themes and structure 1. Introduction to risk in financial institutions. Hull begins by describing the nature of financial institutions, banks, insurance companies, hedge funds, and pension funds, and the various types of risk they face. These include market risk, credit risk, operational risk, liquidity risk, model risk. He also discusses the causes of financial crises, focusing on the 2007 to 2009 global financial crisis as a case study. 2. Market risk. The book explains how market risk arises from changes in market variables such as interest rates, stock prices, and exchange rates. Key tools covered include value at risk, VIR, expected shortfall, ES, historical simulation, and Monte Carlo methods. Hull details how VIR is calculated, its limitations, and how financial institutions use it for daily risk measurement and regulatory reporting. 3. Credit risk. Credit risk is explored in depth, including default probability and loss given default, credit exposure measurement, credit derivatives, e.g., credit default swaps, credit portfolio models. The section also covers regulatory frameworks like the Basel Accords, explaining how banks are required to hold capital against credit exposures. 4. Operational and liquidity risk. These chapters address non-market risks. Operational risk stems from failures in internal processes or systems. Liquidity risk arises when institutions cannot meet short-term obligations. Hull discusses historical liquidity crises and methods to mitigate these risks through stress testing and contingency planning. 5. Regulation in the Basel Framework. A significant portion of the book explains financial regulation, Basel Y, Sinukun, and the third frameworks, capital adequacy, leverage ratios, and liquidity requirements. The role of central banks and regulatory agencies. Hull critically evaluates how these regulations evolved after the 2008 crisis to strengthen the global financial system. 6. Risk management best practices. The final chapters emphasize governance, model validation, and risk culture within institutions. Hull stresses that effective risk management requires integrated enterprise-wide risk management, ERM, strong board oversight, quantitative and qualitative approaches combined. Key takeaways. Risk management is central to financial stability. Quantitative tools like VIR and stress testing are essential but must be complemented by sound judgment. Regulatory compliance, Basel III and beyond, shapes institutional behavior. The 2008 crisis demonstrated the dangers of excessive leverage, poor model oversight, and misaligned incentives,